I want you to picture two people applying for a mortgage on the same day, at the same bank, for the same house. The first person, Priya. Credit score of 742. Responsible with money her entire adult life. Pays bills on time, carries almost no debt, never missed a payment. She earns $78,000 a year. She has $35,000 saved for a down payment. By every conventional measure, she is an excellent borrower. The second person, Marcus. Same income, same down payment, same house, same day. But Marcus has a credit score of 771, not dramatically higher, just 29 points better. He stumbled into a few credit habits 2 years ago after reading something online. Priya is offered a 30-year mortgage at 7.4% interest. Marcus is offered the same loan at 6.9%. The difference is half a percentage point. It does not sound like much. Over 30 years on a $380,000 mortgage, that half-point difference costs Priya $39,000 more than Marcus pays. Not in the distant abstract future, in real monthly cash leaving her account every single month for 3 decades. The bank did not penalize her for being a bad borrower. The bank priced her loan based on a score that was slightly lower. Lower not because she was irresponsible, but because of specific, correctable behaviors that nobody had ever clearly explained to her. This is a story about a system most people interact with their entire financial lives without ever understanding how it actually works, and the very specific, very correctable mistakes that most responsible people are making right now. Today, we're going to talk about the credit score trap, what it actually is, how the scoring system actually works under the hood, the specific behaviors that silently drag scores down, and the concrete moves that produce meaningful improvements in 30 to 90 days. Not gimmicks, the mechanics. Your credit score is not a measure of how responsible you are with money. Your credit score is a statistical prediction of how likely you are to miss a payment in the next 24 months, calculated from a specific set of behavioral signals. Responsibility is not the input. Behavior patterns are the input. And the specific behaviors the model rewards are not always the ones that match common sense financial wisdom. A person who pays off their entire credit card balance every month, keeps utilization near zero, and never carries debt might feel like the ideal credit citizen. But if they signal to the algorithm they are not actively using credit, they may be leaving meaningful score points on the table. The FICO score, used in over 90% of lending decisions in the United States, is calculated from 5 categories of behavioral data. Understanding the weight of each category is the first step to understanding where the points actually come from. The first and most heavily weighted category is payment history. It accounts for approximately 35% of your score. A single 30-day late payment can drop a score by 60 to 110 points and stays on your credit report for 7 years. Not all recurring payments get reported to credit bureaus. Rent payments, utility bills, phone bills, none of these appear on your credit report unless you specifically enroll in a reporting service. A person paying rent on time for 10 years gets 0 credit for that track record. The second category is credit utilization, approximately 30% of your score. The scoring model is most favorable at utilization between 1% and 9%, not 0. 0 utilization can actually be slightly less optimal because the model needs to see active, responsible management of revolving credit. I am not done yet. The utilization calculation has a timing dimension that catches a surprising number of responsible people. Credit card companies report your balance to the bureaus around your statement closing date, not your payment due date. These are 2 different dates. A person spending $2,500 per month on a card with a $5,000 limit, paying the full balance every month, may be showing 50% utilization on their credit report, despite carrying 0 actual revolving debt. Their score suffers not because of irresponsibility, but because of timing. The third category is length of credit history, approximately 15% of your score. Closing old credit cards shortens your credit history in two ways simultaneously. The account age drops and the available credit decreases, raising your utilization ratio. A card you opened 12 years ago that you use for nothing but a streaming subscription is doing significant work for your score just by existing. Closing it to declutter your financial life can lower your score in ways that take years to fully recover. The fourth category is credit mix, approximately 10% of your score. The model rewards having experience managing both revolving credit, like credit cards, and installment credit, like car loans, mortgages, and student loans. A person with an excellent 12-year history of on-time credit card payments, but no installment loan history, is scoring well on 4 of 5 components, but missing the credit mix dimension entirely. This doesn't mean you should take out loans you don't need. The fifth category is new credit, approximately 10% of your score. Every hard inquiry can lower your score by 5 to 10 points and remains visible for 2 years. Multiple inquiries signal credit-seeking behavior, which the model interprets as potential financial stress. Multiple hard inquiries for the same type of loan, shopping for the best mortgage across 5 lenders within a 45-day window, are typically treated as a single inquiry under the FICO model. But multiple applications for different types of credit compound. The first trap is the utilization timing problem, probably the most widespread. Most responsible people pay their credit card in full every month. Many are showing high utilization on their credit report anyway because the statement balance is reported before the payment posts. The fix requires changing the mental model. The goal is not just to pay in full by the due date. The goal is to have a low balance on the statement closing date, the date when the card reports to the bureaus. If your statement closes on the 15th, making a payment on the 12th or 13th, before the closing date, not just before the due date, means the card reports a near zero balance, and your utilization drops to near zero on your credit report. The second trap is the closed account mistake. Closing a card reduces your total available credit and increases utilization. If the closed card was older, the average age of your accounts decreases. A person who closes 3 cards opened 8, 10, and 12 years ago has just shortened their average credit history significantly. The guidance? Keep old accounts open and active, even with a minimal charge once every few months. The third trap is the inquiry clustering mistake. 3 or 4 hard inquiries over 8 months can suppress a score by 25 to 35 points and stay visible for 2 years, signaling elevated credit-seeking behavior to any lender. If you are planning to apply for a mortgage in March, treat September through February as a blackout period. No new credit cards, no car loans, no financing offers. The rate difference between a 745 and a 775 on a $400,000 mortgage can exceed $50,000. The fourth trap is the authorized user misunderstanding. The strategy works. The account's history appears on the authorized user's report. But the trap operates in both directions. High utilization, negative history, and irresponsible use all transfer equally. Before adding anyone as an authorized user, review the account's history carefully, its age, payment record, current utilization. And before accepting authorized user status on someone else's account, review that account equally carefully. You are importing their entire history. The fifth trap is the rent and utility reporting blind spot. You can pay rent on time for 15 years and have zero credit history to show for it. You can have a perfect record of utility and phone payments and receive no scoring benefit. Services like Experian Boost allow consumers to add on-time utility, phone, and streaming payments to their Experian credit file. Rent reporting services allow on-time rent to be reported to one or more bureaus. These tools report payment history you have already earned. The sixth trap is the collection account blind spot. A surprising number of people have collection accounts on their credit reports. medical bills, gym fees, disputed charges, and are completely unaware these accounts exist. Under older FICO models, still used by many mortgage lenders, FICO 2, 4, and 5, any collection account, even for $50, carries full negative weight. A $50 parking violation in collections can meaningfully damage your score under these models. The Fair Credit Reporting Act gives you the right to dispute any inaccurate item on your credit report. The Bureau has 30 days to investigate. Corrections that remove inaccurate negative items can improve scores meaningfully. The seventh trap is the score variation blind spot. Most people believe they have one credit score. FICO alone has over 60 scoring model versions. The score you see on Credit Karma, your bank app, Experian's website, almost never the exact score a specific lender will use. The score you see on your phone is almost certainly not the score a mortgage lender will use. Mortgage lenders use FICO 2, 4, and 5 from the three bureaus and take the middle score. Auto lenders use FICO Auto Score 8. Knowing which score matters is more targeted than optimizing generically. Now let's talk about what you specifically do with all of this. This week, pull your full credit report from annualcreditreport.com, the only federally mandated free credit report source. Not just a score, the full report with every trade line, every inquiry, every collection account. Read it line by line. Look for accounts you do not recognize, inquiries you do not remember authorizing, collection accounts you were unaware of, outdated negative information. The FTC has found roughly 1 in 5 consumers has an error that could affect their score. This month, find out your statement closing dates for each credit card. Make a payment before the closing date, not just before the due date. Low balance on reporting date means low utilization, which means a higher score. This quarter, call each of your credit card issuers and request a credit limit increase. Ask first whether the request will trigger a hard inquiry. Many issuers do a soft pull only. If approved, utilization drops immediately without changing spending behavior. Review any old accounts you have closed in past years and consider whether reopening or replacing them with new accounts from the same issuers is worthwhile to restore available credit. This video is for educational purposes, not financial advice. Credit scoring models, issuer policies, and individual circumstances vary. If you are dealing with significant credit challenges or making major financial decisions, please work with a qualified credit counselor or financial professional. Now, back to Priya and Marcus. The $39,000 difference in mortgage costs was not the result of dramatically different financial lives. Priya was not irresponsible. She was simply operating in the credit system without a clear understanding of the specific behaviors the scoring model rewards. Marcus did not have a rare financial advantage. He had read something online 2 years earlier about statement closing dates and utilization timing. He implemented one habit change, paying before the statement closed. He had not closed his older accounts. That was the entirety of the difference. A few specific behaviors understood and applied over 2 years. The gap between a 742 and a 771 is not the product of decades of different financial behavior. It is the product of a few specific, correctable habits nobody ever explained clearly. The credit scoring system is not designed to be fair in a philosophical sense. It is designed to predict lending risk. The mechanics are known. The levers are accessible. And the gap that cost Priya $39,000 is entirely within her control. Think about the full financial surface area that credit scores touch across a lifetime. Mortgage rate, auto loan rate, credit card APR, insurance premiums, some employer background checks. A person consistently at 750, 800 versus 680, 720 pays less across every one of these surfaces for their entire adult life. The lifetime dollar difference between these two score ranges, mortgage, auto loans, insurance, credit card balances, has been estimated by financial researchers at anywhere from $50,000 to over $200,000, depending on individual borrowing patterns. That is not a trivial number. That is a retirement contribution. That is a college fund. That is years of financial options that a higher score generates quietly, in the background, across decades. The trap is not malice. The trap is opacity. And opacity, once lifted, loses most of its power. The 29 points between Priya and Marcus were always within Priya's reach. They still are. The choice is whether you understand the system you are being scored on before your next loan application or after it. One costs you nothing. The other costs you decades.